Welcome back to the Deal Flow podcast. I've got two great guests for you guys today, Dale Holzer and Jonah Aelyon. Am I saying that right, Jonah?
Aelyon, perfect.
Aelyon. Okay. So Dale is, I'm dropping last names, everybody. I'm going to go straight with first names so I don't have to mess them up anymore. But Dale is managing director at JLL Capital Markets based in San Diego. Lucky Dale. He's a Wharton grad, spent 12 years at Greystone as an agency lending specialist before going to JLL. Dale has deep expertise in Fannie Mae, Freddie Mac, and HUD financing with a focus on multifamily and workforce housing across Southern California and Western United States. JLL was the #1 direct Freddie lender in 2024. Dale brings an institutional level perspective on where the agency markets are headed. And Jonah is also a director at JLL Capital Markets based in San Francisco. Still a little jealous, although I think I prefer San Diego maybe to San Francisco, depending. He came up through University of Wisconsin, built his career at Freddie Mac and HFF before joining JLL, and he has closed over $5 billion in transactions with significant experience serving large institutional sponsors across the West Coast, including the Bay Area, Southern California, and the Pacific Northwest. And so with that, I'm going to pass it off to each of you individually in case you had anything else to add to your bio. Both have storied careers, and you guys have done a lot of transactions. So I'm really looking forward to diving into the market, what you guys see right now, and what you guys are looking to see in the future. So we'll start with Dale. Why don't you just round out your bio and then we'll go to Jonah.
Yeah, appreciate that, Michael. I'm going to bring that script into my next meeting on the intro. Yeah, I'm, as you noted, I'm really from the Northeast, New Jersey, the Philadelphia area. Went to Penn, a great place to kind of get a feel for finance and real estate. Graduating from college, I was not a guy who wanted to go to Wall Street, and for me, the priority was finding my happy place, which is the sun and the outdoors and being in a financial district, which was Los Angeles to a large degree. So I was excited. I was a kid that moved right out of college, didn't know anyone really on the West Coast, and just thought I was going to lay my stake and make a career out of it. And I felt very fortunate. I still do that. I started at George Smith Partners, not to give them too much credit, but it was a nice local shop working on the mortgage brokerage side. It was just a great place. You touch a lot of folks out there, kind of figure out who's doing what, who the players are. And it's a great springboard, to kind of figure out where you're going from there. Unfortunately for me, I started my career right around the GFC, the beginning of the GFC. Mm-hmm. And I will say I was smart enough to find the couple places that were still doing business, and those were agency shops. Again, felt very lucky. I got a job in agency underwriting. I thought to myself, I want to become a technician, learn the underwriting. And then I thought I always had the personality to be on the production side. And really that was the career path I took, and transitioned that to Greystone. Had a really nice career there. Ultimately wanted to come over to JLL, where not so, just not solely focused on really kind of just a couple lending products. As you mentioned, I have a lot of experience in the Fannie and Freddie space, large and small, the HUD business, and really just multifamily in general, but they do not have a capital markets group. And that is why I ultimately made the transition over here earlier this year. So that would be my intro.
Awesome. Well, congratulations on making that move earlier this year. Jonah, why don't you round out your bio for us?
Absolutely. Very grateful for having landed at University of Wisconsin-Madison, because that's how I found this industry. Had no exposure to it previously to that, and just had the opportunity to try different internships every summer. And similarly to Dale, felt that my personality was a little bit more suited towards the brokerage advisory segment of the industry. And after a quick stint at Freddie Mac, which helped me dive into the multifamily financing industry, I made the move to HFF, the predecessor boutique capital markets firm that JLL acquired in the summer of 2019. And I would never have guessed at this age that I'd have been at a firm for 8 years, but I'm sure I'll hit 10, I'm sure I'll hit 15, and will probably hit 20 as well. So it's been a good run so far. Nailed it on the head. My background is really in the multifamily financing space, anywhere from construction, agency, perm to bridge. We do it all. And after, entering my 5th year of production, I'm starting to spend a little bit more time on alternative product types, whether it's student housing, manufactured housing, some self-storage, and small bay industrial. It's what's one really fun thing about this job is that you're able to learn things every single day, whether it's different specific deal structure, new product type, new lending program, you always have to be adaptable to new information, which has really kept it dynamic every day. So thanks for having us. We're excited to be here.
Yeah, no. And that'll be all today, guys. No, I'm just kidding. So now that we got the intros out of the way, and I'm really excited because you guys both have long careers and done a lot of business, seen a lot of different deals, a lot of markets, a lot of opportunities. And so both at JLL was the number one direct Freddie lender in 2024 so far as total production. Tell me a little bit about why that's important or how that helps clients. And that could be for either one of you.
At JLL, so what I would say is, we have a phenomenal team led by a couple gentlemen, Luke Vanderpool and Stephen Henderson, out of our Dallas and Houston offices, full of closers, underwriters. So big hand goes to them in helping facilitate our whole platform. And then what I would say is, a unique thing about where Dale and I sit on the West Coast is the lead of our multifamily debt platform here at JLL sits in San Francisco, and having that access to one of not only a prior advisor on the Freddie Mac Council, but a leading originator with Freddie Mac every year gives us some additional access, which is really helpful to a number of our clients. And while we pride ourselves on our Freddie Mac business, in 2019, when JLL acquired HFF, we've been doing more Fannie Mae business since as well. So we're hoping to be number one in both as we move forward. And again, Dale hit this earlier, but one of the reasons we think clients choose to work with us compared to some of our competitors is that oftentimes we do run a full process and full bake-off within the lending community. So, I think experience would tell both Dale and I that many producers and advisors in this business, in the multifamily sector specifically, are just talking to Freddie Mac and Fannie Mae on a lot of deals. But roundabout way, we love Freddie. They're always a top 3 lender of ours. And I actually started my career there. So have a lot of love for them. And JLL has a lot of Freddie Mac alumnus as well, which I think really helps that level of connectivity around the country.
Excellent. Okay. What I'd like to do next is really talk a little bit about the kind of the debt markets, what happened. We're here in December of 2025, so we're just about at the end of the year. I'd like to talk a little bit about 2025, and I think some folks have said that 2025 was the year when the debt markets finally thawed. That being said, there seems to have been a lot of transactions and a lot of business happening these last few years, even though people have said that maybe they were closed off, but there's still a lot of deals getting done all the time. From your seat, what were the defining characteristics of the 2025 debt landscape? What was the characteristics and what kind of surprised you maybe?
Yeah, no, it's actually such a good question. And it was a transitional stage for me, and there's a lot of new capital relationships, that I think I found, and just unbeknownst to me, how much debt was available out there, between, the activity within the banks, the life insurance companies, the debt funds. And really, going into this year, a lot of the talk for, I would say, the 12 to 24 months past was, how to get pref equity and engaged on deals and be capitalizing in that way. And what I found to be the most surprising is, really how the senior debt just stretched, this year to go to debt yields that I thought wouldn't exist for a few more years. And, leading into the stories and, how, we're going to get a 6 debt yield to an 8 debt yield with a little bit of your imagination, but that capital is out there. It's been very aggressive. And for me, again, transitional year, but I've closed a few deals. They've been with life insurance companies, and kind of like the old idea of it's your grandparents kind of, at the life insurance company in middle America somewhere. I mean, these guys are getting very aggressive. They're competing with the agencies and a lot of times, better structure and more loan proceeds. So kind of just some nice takeaways for me in 25.
Yeah. So I've seen as on kind of like the receiver end, it's just everyone is out there, right? Like all the different food groups are lending, and it seems like we're getting, a lot of things are more competitive than they would normally be this early cycle. Or what I would consider to normally be early cycle in this space. Not almost similar to the terms I was seeing in, late stage last cycle, so far as margin and spreads and maybe not quite LTV. Obviously, valuations have come in. I guess, Jonah, is there anything more you want to add to, I guess, the competitiveness of the market and how that's, is that a phenomenon of this year that's coming back, or what are you guys seeing so far as, how competitive everyone is, and what does that mean for the market?
It's great for the market. There's levels of liquidity that haven't been seen before. So it's this interesting dynamic of not as much volume is getting done as the peak, but in turn, there's more liquidity and capital that's been raised since then. So there's this dearth of deals in the space. So predominantly in the private credit space, where there's been record levels of capital raised, there are way more debt funds than there are deals. So particularly when you're above the $20 to $25 million deal threshold, you can have 15 bids that kind of all make sense. And what we're seeing is there's always going to be a handful of outliers that really want the business. And to your point, as a borrower, what you're experiencing is you've got the leverage again. And the negotiation is different than it's looked like for the last 2 years. It's back to asking for things like 4-year initial terms or untested initial extensions. You're getting very aggressive prepayment structures, leverage levels. I know I mentioned a deal to you are getting as high as 83% of cost, and there's just not enough deals. So bridge space, very aggressive. And what I would say, you'd probably be surprised to hear that more than a quarter of our business here at JLL has been with banks. So whether it's regional, local, domestic, or foreign large, there's a lot more liquidity on these balance sheets. And because those larger banks are priced off these SOFR swap indices, there's an inherent arbitrage of more than 25 bips. So this bank pricing is driving everyone else down, and that's creating a lot of competition. It's a great time to borrow in the multifamily and industrial spaces specifically.
Yeah. So maybe we could, I know you had, I guess, referenced a recent deal that you'd recently done and closed. Maybe through the lens of talking about that deal, you can talk a little bit about your local market and what you're seeing today. I think you had said it's, why don't you tell me? You tell me
Sure.
about it. And,
So one correction, not my local market. Deal was actually in Seattle, north suburb. And this suburb has experienced
it's only like 1,000
double
miles away. I mean,
yeah, close enough. I mean, honestly, do more business in the Pacific Northwest than the Bay Area in many years.
Sure. Yeah.
So this was in a submarket where multifamily supply has doubled in the last 3 years. Concessions are still at 6 to 8 weeks. Very organized, sophisticated institutional sponsors still believe they're going to be there for at least another 12 months and at least at 4 weeks of concessions. So it's really critical to set the stage. And so that was a construction takeout loan of a senior and preferred equity stack. And to get to a cash neutral level of proceeds with where valuations are today, it resulted in an 83% of cost deal. Quite high leverage. Majority of the bridge market tapped out at 75% of cost. There were a handful of groups at 80% of cost. And then 3 lenders separated themselves at the ask of 82%. And ultimately we landed pushing up to 83% to cover some unexpected closing costs and even a very small repatriation of equity. And this deal had a few really strong characteristics. A, $83 million loan. When you're above that $50 to $75 million space, the competition gets very, very aggressive. B, one of the largest multifamily institutional sponsors nationally. So you have a very good borrower. And C, despite being very high leverage, they just built the deal. And although the leverage percentage is high, they still had, north of $20 million deal, $20 million left in the deal. So that resulted in a very aggressive level. And we're seeing that here in the Bay Area as well. We've had a lot less delivery here, but I would say capital to the Bay Area, it's one of the most one of the markets that capital is focused on most in the entire country right now. It's top of the charts on rent growth. It's been the poster child of markets to stay away from. And everyone is over that hump. So it's very exciting here in San Francisco.
Yeah. Well, I think you've got, a new excitement around the technology and the AI infrastructure and all the money pouring into that space. Obviously, a lot of that lands in the pockets of folks near the wharf, I guess. Right. So yeah, no, and it's a great city. So I feel like the contrarian play always seems to make sense to me. And right, any list that says, hey, here are the worst 10 markets, maybe it's time to start looking at those markets, right? Because then the next
Absolutely.
year they becomes the best market, and people kind of throw the baby out with the bathwater a lot of times. So
Mhm.
going back to you, Dale, on just I know that Fannie and Freddie released that they're going to be increasing their caps for 2026 quite a bit to handle the wave of refinancing activity that's going to be coming that has been growing and growing. Maybe could you talk a little bit in 2025, how much of the business, your business or JL overall, was refinancing driven versus acquisition driven? Because I think that kind of tells you a little bit about where we are in the cycle. And how did that maybe compare to prior years in this cycle?
Yeah, that's a great question. And Jonah, correct me if I'm wrong. I want to see off the top of my head. I mean, 24 was just so anemic in acquisition financing. Maybe it was 20% or 25%. I think now we're closer to healthy. I mean, healthy is kind of would probably be defined as close to 50-50. I think though
Mm.
we're
I
around.
looked this morning. It's
Oh,
very close on the 50-50. We're at 45% acquisitions, 55% refi, including construction.
And that's
mhm,
that's what I would have thought is we're getting closer to healthy.
mhm, mhm.
So I mean, I kind of working through that question. I mean, in the agency business, maybe folks on this phone. I mean, agency historically is 7 or 10 year fixed. In 21, 20, anyone who didn't lock in a 2-3 handle 10-year rate full term IO probably kicking themselves right now a few times. But
Including myself. Yeah, no.
yeah, we
Or at least
we all
for
we
some
all
deals, right? Not everything.
we all have a few of those, so that's all right. But really the name of the game over the last few years is tightening maturity to five. Most folks to want a 5 year. Fannie and Freddie have really leaned in on that space. Basically, they pushed off the business by having some artificial stress tests and LTV exit tests where you really couldn't get the same proceeds because they liked a little more amortization as you worked through the loan maturity. So they
Mhm.
leaned in. I think they've more than done their part in a market where they've leaned in on the 35-year amortization over the last few years. They've tried to, keep the IO standards, but in the midst of all that, there was a lot of headwinds too. There was a lot of
Mhm.
fallout from some fraud issues last year. There's property condition where, Fannie and Freddie and headline risk. It's out there where you had a lot of this kind of high flying money going and doing minimal work to properties and raising rents 20, 30%. At the end of the day, Fannie and Freddie, they are a quasi government entity and they really, started to hone in on that over the last, 12 to 18 months. And we're seeing some of that. So the business isn't maybe quite as easy to get done, but there's certainly still a lot of agency business getting.
Yeah, yeah. No, I think it's a great, if you're in the multifamily business, you always know you got the agencies, even when everything tightens up. But it sounds like, from what I'm hearing, the spigot is open for, all these different lender types, right? So,
That is right.
the agency is not the only game in town. And I assume that, you have some borrowers who are like, hey, I'm an agency guy. I'm going agency and going agency. And you're like, well, hey, you got this other option over here. Could be better. Could be more
Yeah.
proceeds. Could be a little more flexible. So let's talk a little bit about that. Let's talk about the landscape. You guys have brought up some specific deals and kind of generally spoke to different types of lenders, but let's get into a little more detail. I'll put this one over to you, Jonah, about lender types and maybe
Yeah.
talking a little bit about what are some of the key differences. Like if I'm a borrower and I'm looking to, I got a $25 million loan on a, property that I'm looking to get done and it's stabilized, and so well occupied and maybe got a value add or whatever. I got banks, I've got, the agencies, I've got debt funds, I've got life companies, I've got CMBS. Maybe you could talk a little bit about some of the core differences between these different types of lenders and why you might pick one versus another.
Absolutely. So yes, very healthy, diverse set today. Lots of liquidity across all segments. More than a quarter of our business is banks, more than a quarter is debt funds, about a fifth is insurance. And you'd be surprised to hear, but only 15% is agency. So if you're a borrower, Dale and I are multifamily experts. So let's talk multifamily. If you're talking CMBS, there's probably something wrong with the deal. or maybe as a borrower, you have some credit blemishes, which are making other lenders not possible. Other than that, the only reason to do CMBS is if you need non-recourse and you've got a very small mixed use asset that, let's say, is 50% retail income and 50% multifamily income. The non-recourse bank programs, many are not going to compete on that. And then that's too much retail revenue for the agencies and insurance companies in many cases to offer a multi-deal when it's that small of a loan. So CMBS aside, you have a transitional asset. You're pouring money into it. Maybe you need help with equity. You don't have a JV partner and you're a syndicator. Debt is still generally low. So that would really be a good time to borrow from a debt fund. It's going to preserve the flexibility of a short-term sale. They're going to fund your renovations. And if you're comfortable going up the risk spectrum on leverage, they're going to be there for you, as you heard earlier, generally up to 75% of cost. Other cases to take bridge money would be if your deal is leasing up and not yet stabilized and you want some flexibility. But debt funds is really all about leverage and flexibility. Those are the two biggest reasons to take that paper, and also very short-term hold periods, which goes into flexibility. Agency is when if you have got a cash flowing multifamily deal that's clean and you're focused on best cost of capital, today, as we sit in December 2025, nobody's touching their pricing, particularly if you're going to use a buy down. 3 weeks ago, I rate locked a 69 basis point spread. I've never heard of a spread that low. And that was because it was a big
You
loan.
heard it here first, everyone. 69 basis points. Go to John.
Exactly.
Give this guy a shout out here.
So it's really hard to compete with the agencies on a non-recourse cash flowing multifamily deal. And, we sit in the West Coast with where cap rates are today. In many cases, you're not getting north of 65% leverage on a 125 DSCR. In some cases, though, the agencies allow for up to 75%. So it's not a leverage tolerance. It's just a cash flow. If you're buying a deal in the middle of nowhere in the Midwest, 8% cap rate, yeah, you're getting full leverage.
I'm going to jump in there. Just
Go ahead, Dale.
One of kind of what I think anecdotally is the most interesting things happening right now is obviously you're being a little facetious on an 8 cap, but Class C multi in a lot of major markets out there, Phoenix, Texas, Florida, that stuff's trading at a 6.5 today in place. Assuming you have some decent operations. So a lot of those places are struggling with supply coming online and vacancy and whatnot. But long story short, we're seeing, I think it's intriguing. We're getting there where, 6.5 cap trades are happening. And if you can kind of just project that rents aren't going down, vacancy's not going up, you have some stability, and you could put a 5% interest rate on that. And that's 150 basis points of positive leverage. And that to me has probably been the most interesting, on the ground feedback over the last 2-3 months.
Yeah. Yeah. It's almost, I would say that's getting back to where maybe things were in the middle of 2010. You could get 5% agency debt. You go into a 6 cap in the Midwest, at least, or some of these a little bit less, not the South at that time, I guess, not the Southeast, because the Southeast was sort of heating up and maybe you weren't getting that quite, that delta, but definitely looking to be more of a normal market. And hopefully we'll get to stay here for a little while before those cap rates compress. And, that story of positive leverage becomes, well, it's leverage neutral, it's only, you're getting 25 basis points of positive leverage. That's when, I think then we're sort of like in that mid cycle. And then it's when we start to say, well, hey, every deal's a bridge deal because I need to push on price, right? Which, Jonah, to your point, like, you shouldn't be using bridge to push price. It's more of a business plan. You pick the debt based on the business plan, not based on where you, how you win the deal, right? I don't know if the person who wins the deal pays the most price. I don't know if that's always necessarily the best things. Follow-up question for you, Dale. Maybe how, and I think there was a mention a little bit about some of the issues around fraud in the industry and the agency business, particularly. How has that affected maybe the underwriting for agency or otherwise today versus maybe a few years ago, right? How has that changed? We'll start with Dale if you have something, and then, Jonah, if you want to add anything. But I think that's an important factor. I've certainly noticed it as a sponsor that things have become a little bit more of a pain.
Yeah.
Sponsor.
Yeah.
Nice
No, I
way
mean,
of
look,
saying it.
they are, it's a top to bottom with both Fannie and Freddie, and maybe just lenders kind of more holistically. But they're wanting conformance in the escrow and title companies we're using. Anything along those lines of the KYCs or know your clients are just much deeper. So we all go back and kind of a hindsight 2020 and think, oh, well, why didn't we really do it this time or that time? And they're certainly back to a setting a rigid framework. In a lot of ways, it's very cumbersome if you have an owned property and they're just for everyone to keep in mind. I mean, Fannie and Freddie are two separate entities. We kind of use them synonymously as one agency, but they're separate. They have different staffing and, some iterations to their credit tempos and whatnot, but they seem to be pretty aligned, wanting to, make sure that we're doing a good job, financing folks that I think in a lot of ways deserve to be financed with tens of millions of dollars. And I think it's frustrating for all of us as we're going through, kind of on the production side. But like anything, the first time you do it and you get through the hoop, things get easier. And I'll stop there. But yeah, there are a lot of folks that have borrowed a lot from Fannie and Freddie, and I think they're going to be surprised, that there's a higher level of critique coming back through the pipeline, especially on their existing deals with both Fannie and Freddie.
Yeah. So I'll add something to that and then pass it over to Jonah. Would be there's talk of having Fannie and Freddie become they're in receivership, right? They're owned essentially by the U.S. government. There's talk of perhaps letting that expire or selling it back to the market, letting it be a freestanding enterprise to some extent. Is there a lot of talk about that in your shop about what the implications of that might look like? Do you think that's going to happen? Do you guys have a view on that? And then if it does happen, what should borrowers maybe be thinking about? Is that going to change how competitive agency debt is compared to some of the other food groups? That'd be for you, Jonah.
Okay. Sorry, I thought it was for both of us. So
No.
I would say I personally haven't heard our firm really talk about it and or have a view internally or externally. So I'd be curious if Dale has heard differently. From a personal perspective, I tend to believe that it's not going to change. The interest that they make is one of the biggest cash cows for the US government. We currently have a president who has made his wealth through real estate, and I would think he, more than others, understands the implications of that removal, of that strength as a lender in the multifamily market, which is the biggest piece of our commercial real estate market here in the United States. So I tend to personally believe it's not changing. That's a Jonah position. We'll see if something changes. But as far as implications, yeah, if you're a multifamily borrower, I think that's going to completely change the dynamic of the borrowing landscape. I don't necessarily know psychologically that all rates will go up because they don't have that low pricing power, but that would really change the picture. And while they still might exist, their rates would be not as low.
Right. Yeah. Anything,
All right.
Dale, you want to, you have a comment or a thought on that?
I'm going to make the script more interesting. I'm only speaking for myself here, not any part of
Sure,
JLL's
absolutely.
view. And I'll say, look, we can all see that this administration, they have intention and they get it done. It's kind of amazing to see, but, I put Fannie and Freddie next in the crosshairs. I think, when you really first take a look at this, you have to bifurcate that you have the single family business and you have the multifamily business. They're completely separate. And the multifamily space is just a drop in the bucket compared to all of the business that's out there, Fannie and Freddie in the single family space. Again, don't quote me on this, but I think it's something in the realm of like 90-10 or something on the percent of the business that gets done for multi versus single family. So I don't know how they get this done because again, there are a lot of smarter people out there, but I believe right now it's kind of like almost classic kind of like M&A activity. They're almost streamlining the programs in a lot of ways. I'll go back to almost one of your questions. They're starting to just, if the business is under 10 million in loan size, they want to, kind of stop. They want to make it more vanilla. They don't want all the exceptions and all the, give me the boots, the suspenders, whatever, the straps and everything. They just want to kind of get that business flowing. You see them still financing a lot of the institutional space. That's where a lot of the business is really getting done. You see a $1 billion portfolio with Blackstone here, Starwood there. They're pushing that business, and I think they're making a vanilla and chocolate because that's what makes it easier to monetize, in the private sector. This private sector, again, this is just me, but I don't think they want to understand, sponsor initiated, housing or, And I do think there's going to be optics on the political side. They still need to finance or have an objective to help, the public out there within the affordable space. I just think, it's very possible that they get this done. And when I quantify it in a way where, again, I think the single family, I just can't comment on that whatsoever. But I mean, Jonah can attest to this. I mean, we're seeing spreads by insurance companies and other, banks out there. They're only 25 basis points wider than the agencies on a lot of deals. I mean, that's not going to make or break a multifamily, deal or the market in any way. Again, it changes a little bit. Now you have, this much business that is maybe going to transition in the environment out there. But yeah, I will not discount any initiative this administration wants to do. So that's my opinion on this.
Yeah, we'll see. I think they're probably going to be more to you guys' point or to your point, Dale, about the 90-10. I think they're more focused, if anything, about figuring out how to get spreads down for single family mortgages. And hey, all they got to do is start buying MBS again and it'll be fine.
Yep.
We know how to do it. So they just have to start doing it. And I wouldn't be surprised if we'll see that, come next summer. We have a new man in charge at the Fed in the spring, but we'll see. And so with that being said, about things that we'll see about, we're going to talk a little bit about outlook and predictions now. As I mentioned earlier, agency caps are up from 73 to 88 billion each year. That's a big increase. So obviously, that means there's more refinancing activity. There's more deals from 21, 20 that need to come back around. But it sounds like there's a lot of other options out there. So for folks that are maybe sitting on deals that they did with agency debt in the 2018 to 2021 timeframe, or maybe they're trying to get out of bridge debt, there's a lot of debt that's coming due or has tried to come due this last 12 to 18 months or 24 months that has had to extend. And we're getting kind of the end of that, the extension ability for a lot of these 2021 vintage bridge deals. What would what do you think that signals about the market so far as these increased caps? And how should sponsors be looking at, that landscape if they have a pending maturity, maybe from the perspective of how they should be repairing their properties for that financing and maybe what alternatives, if they thought they were going to go agency, what would be that, easy alternative maybe to agency to kind of to think about that. And I'm going to give it to Dale because I feel like I've been favoring Jonah because in my screen, he's in the middle. So it's not, no favoritism. It just happens to be that he's in the middle of my screen here. So, but Dale, maybe speak a little bit about that. What do caps have been increased. What does that signal about the market and maybe how can borrowers be prepared for agency financing and going into next year?
Sure. I think, and Jonah and I are seeing this on a firsthand basis. I mean, these bridge lenders have been good to work with, and I think a lot of circumstances they've been doing a kick the can to, I think in probably everyone's benefit, borrower and lender included. But they've been doing a good job, and I think they are at that tipping point though, where hey, it's been great knowing you, but it's time to go get married to someone else type attitude. So we're seeing that in the market right now. It's a very deal dependent question in the market, especially. Depending where you are, you have local banks, regional banks, national banks. Some places you don't have many of those really, if it's, in the middle of America somewhere. Yeah, lots of liquidity depending on the market. Agency is very much still going to be a large part of that liquidity, but I don't think the expectations anytime I see this year are just going to be every deal is a 75% LTV, 125 DCR. They're ratcheting back their parameters depending on market location and you can kind of qualify the markets in different ways, and Fannie and Freddie work differently. But you basically have your top kind of core, 10 MSAs, which are strong, and then you get to kind of your major MSAs, and then you get these kind of small, very small markets. Michael, I know we've kind of even had part of that conversation too on, where some of that sifts out. General temperance is, in a matter of fact way of saying it, they are pulling some of the parameters back and on an IO basis as well. So just need to keep that in mind, when you're going in, that every deal is not going to be, at a 125 DCR and a massive cash out. Just not to beat a dead horse here, kind of the bearer of bad news, but really, guys, if your agency lender, whoever that may be, is interfacing with you on the servicing and the asset management, for specific property characteristics, you really need to take that seriously, because they have a good boy and a bad boy book. And when you go on the bad boy book, it's hard to get off. It's a lot of work. And you're losing a lot of leverage in the capital markets out there.
Absolutely. I mean, and that goes even to just making sure you get your financial reporting out in time, right?
Yep. Yep.
Simple things. Even if you're totally in compliance and you're not, technical default, is still technically a default.
Yep.
So just be aware of that. Don't neglect your asset management duties and your servicing duties as a sponsor. Jonah, let's talk a little bit about rates. So 2026, I think everyone thinks or hopes or prays, that rates are going to keep floating their way down, whether that's on the short end, which, we just had another Fed cut and we're the market at least is expecting another one here soon in early December. We do expect maybe one more before the end of the year and maybe some more next year. Certainly that's what the market is hoping for. What are you seeing and what are your clients saying? Are they thinking that same way? Are they sort of holding off on doing their financings as long as they can, hoping to get that next lower rate? Or, what is your kind of view and what are your clients saying regarding rates in 2026?
Absolutely. Two quick things to add on to Dale's that borrowers should prep to do though before financing deals. Quickly, talk to your advisors, your Dale and Jonah's early. Don't wait till
Dale and Jonah specifically.
Don't wait 2 months before your maturities due. Start talking 12 to 18 months. Start talking through ideas. And then B, to Dale's point about property condition, fix your property. Get it ready so that PCA comes back sparkling clean. Okay, to your question on rates, we'll see if you like my answer. I have been in the business for 10 years. An advisor for about 4 now. And what I jokingly but seriously say to clients is, I don't like to prognosticate rates. And if you did, you should go into a different business. We're in the real estate business. And I have seen, let's use the word greed of somebody waiting for a better rate. I have seen that go in such poor directions where it's the difference of somebody getting a cash neutral deal to a $10 million cash in because they waited 6 months and were wrong. So I don't think people should make their decisions based on their crystal balls, because I firmly believe you can find any economist, any really sophisticated borrower that can argue either direction really intelligently based on micro, macro economic data and historical patterns and behaviors. So I like to tell borrowers, if this interest rate works for your deal, the math works for your investors, take it. Don't wait. That's been my advice since COVID started. As far as borrowers, you hear everything, but I would say today, at least in my experience, I'm curious Dale's, I definitely have many clients and or prospects who are very excited about where they think rates are going in early 26 and beyond.
Dale, quick follow-up. What do you hear from clients as it relates to what's happening? What do they think is going to happen with rates next year? Sentiment.
Yeah, well, this is where I'm almost surprised, given, the property size and the sophistication of I think folks out there in the real estate market, that a lot of people haven't really put the 2 and 2 together. The Fed funds rate can go down, but that does not make your 5, 7, or 10-year fixed rate mortgage go down. We're seeing a little bit of that right now over the last few weeks. That has been just, sending that message and kind of beating that same drum has felt like, the past 24 months have been just consistently that. And I think if you just kind of take a brief look into Econ 101, you can understand, the inflationary pressures that are created even over the last couple of years with an ultra low, Fed funds rate. So there's some of that going on. We have all these other things with tariffs and all that. The end of the day, though, I'm going to go back to Jonah's point. We have a real estate business friendly administration. I think no matter what happens between now and we'll go off your next summer kind of prognostication. I think the administration gets rates lower. There could be a lot of turbulence in between now and then, but I think they come in with a heavy hammer at some point in the next 12 months.
I think if they had their druthers, then yes, we'll see how the market reacts to that. And I think there was you don't fight the Fed, right? When the Fed's moving rates down, you want to go with them. When they're moving rates against you, pay attention, because that's going to throw a cold water on you. So we'll see. Or maybe we're continuing to move down, maybe we're not. But I agree, right? You just got to get into that medium or long-term debt, cash flows deals, right? At the end of the day, you want to, they were saying before, survive to 25. I don't know if we've come up with a new slogan, right? I don't know what it might be. I don't know. Have you guys heard any new ones on what's the new slogan? Since 25 is done now, and we still haven't gotten to I think that the next cycle time. You guys have any new slogans?
You know what's exciting is I don't think we need a slogan anymore.
You don't think we need a slogan anymore? Oh my God. Okay, fine. I'll allow it. We'll
back to doing deals.
Just doing deals. Okay.
Ride or
Blinders
die. Ride or
on
die,
deals.
Jonah.
There you go. So I'm going to give you guys a little bit of to make a case for two different areas, right, where you guys are located and like to do business. So I'm going to start with you, Dale, and have you talk a little about Southern California and the Inland Empire. And then, Jonah, I'm going to have you talk a little bit more about the Bay Area. I know you touched on it, but just prepping you guys for that. So, Dale, in Southern California specifically, you mentioned in some other your comments about the Inland Empire and positive absorption and tightening vacancy. What's your outlook for your markets for 2026 and beyond? Right, we are long term investors. So, hey, is 2026 a great entry point for your markets? Is it a whole wait and see, wait for concessions to burn off? What do you think?
I think the guns are getting turned back on to California. It's going back to basic real estate fundamentals. Our supply is limited. There's a lot of press about folks obviously going to other parts of the country. I've personally felt like there's going to be a boomerang effect. I'm one of those people, moved across the country to be here.
Sure.
And I'll just go back to the supply. I mean, if you talk to our IA teams or investment sales teams, they're still struggling to get business done in places like the Southeast. A lot of fallout there. To Jonah's point, they'll tell you San Fran's one of the back to the hottest market with rent growth. And you see California needs to be kind of stratified a little bit differently. I mean, LA's still got some challenges. Orange County has held up very, very well throughout all of this. And then San Diego's probably somewhere in the middle. They've had some more supply come online. But again, I think the long-term thesis is, rents have been subdued here due to, some red tape that's hung on post-COVID. And there's just a lot of mark-to-market in these rent rolls that we still see out there. So don't have to make giant leaps of faith on business out here. I think this is the place to be for the next couple of years.
Excellent. Very good. Jonah, why don't you talk a little bit about the Bay Area? And I think that, the headlines have been, maybe less so in the most recent time, but maybe in the last few years, been a little bit tougher, maybe politically, and kind of the ground game, at least what we hear as people who don't live in the Bay Area, right? And we hear a lot of news on various things. Maybe tell me a little bit about what you're actually seeing, and what do you think you're going to see going into next year? Is now the time to buy, hold, sell? What do you think?
It's interesting. It's buy, hold, and sell time in different ways, actually.
Is that a real response?
So as a sell side analyst, I don't think you could say, hey, my recommendation is buy, sell, and hold, but I'll let you do it on that.
If you bought in the last few years, it's time to sell. So
right.
I'd be mad at myself if I didn't mention our new mayor, Daniel Lurie, here in San Francisco. As he says, let's go San Francisco. He's amazing. He's everywhere.
The slogan right there.
He's at restaurants, sports games, entertainment, like he's shooting hoops in parks. This guy is everywhere, and he's been a major new catalyst of growth here in San Francisco. But 2 to 3 years ago, the headlines were, is San Francisco the next Detroit? Which I found it laughable here locally because it didn't matter if you're working from home, it felt desolate. The education centers here, the wealth, and the technology. And it was, from my perspective, just a matter of time. I actually started buying real estate in San Francisco. We can do that on another podcast. But San Francisco, the political shift is leaving the extreme far left. It's still a liberal city, but it's not where it was. And that's a big thanks to Daniel Lurie. But small business, it's very pro-business, pro-housing, anti-crime. You're seeing it, you're feeling it. ULI was here in San Francisco a few weeks ago. Couldn't have been better timing. Real estate leaders from around the country were here, in some cases for the first time in years, and you could feel it. The energy was palpable, and it's a really great time to invest here. I would say if you made bets 2 years ago, you're looking extraordinarily smart. There's a ton of institutional capital coming across all asset classes. So if you were one of those contrarian investors, now could be a time to sell. If you're a long-term investor, it still makes a lot of sense to keep holding, and growth is extraordinarily high. I know an investor with multifamily in the city, who's averaging 17% lease tradeouts this year. Those are like Southeast numbers we used to hear a few years ago, pre-COVID. So San Francisco is an exciting place that extends through the Bay Area. The peninsula, kind of like Orange County, never really faltered. Cap rates have stayed very aggressive. And by peninsula, I'm talking Menlo Park, San Jose, Palo Alto, very wealthy, strong markets. And I would say the biggest shift now in the city that's going to be really exciting to keep watching from a capital shift perspective is office. I don't know how to spell office. I don't work in the space, but it's tremendous to see what's happening. Big players like Blackstone are back. Deal sizes are getting bigger and financing is there in many cases. So that's been a really exciting shift to see. And it's just a market that's on every institutional investors' radars again, unless they happen to be one of those investors who has California as a red X. But I agree with Dale. There's not enough housing here. There hasn't been, and there still isn't going to be because of some of the red tape that exists. There's a lot of wealth here. There's a lot of beauty here. And along the coast of California, I think it's going to stay expensive and it's going to stay a great place to invest.
Yeah, I love that. Okay, well, great. Well, yeah, no, I was just thinking as you were talking, I was like, oh, we really didn't get into office to multi conversions. Well, we'll leave that for the next time, and because I know that's happening all over the country, and to a great extent, and probably in some of your markets. But we went a little bit longer than I normally do, so hopefully you guys, I didn't blow through your next meetings. But we're gonna do a rapid fire, a couple questions here. So first, and I'll give this to both of you guys in sequence. First, Dale, then Jonah. Best piece of advice you've received in your career, Dale?
Don't just look over the ledge, jump. You'll land on your feet.
All right, Jonah?
Nobody else thinks like you.
Okay, all right. And now another one here for rapid fire would be, what is a common misconception about debt brokers that you'd want to clear up? And we'll go Jonah first, then Dale. So common misconception about debt brokers.
The misconception is in the question. With the word broker, it's a half joke, but here at JLL, we want to be your advisor. We want to be an extension of your team, your CFO, CEO buddy. We want to be there to solve all your problems, not just a call away when you are buying your next deal.
Got it. So what is a common misconception about debt advisors that you want to clear up, Dale? I'm using your language.
I'll tell you one that I run into here at JLL, and it's that we are just we're just on the capital advisor side when we are a Fannie and Freddie lender. I know it's not the largest percent of our business, but we're top number 1 and number 5 respectively. Maybe that interchanges right now, whatever. But we are a huge agency provider, and would love for folks to know that.
Excellent. Okay. Well, just as we're wrapping up here, where can listeners find you, and what's the best way to connect? Dale, why don't you go first?
LinkedIn's always great. I'm on there, have somewhat of a presence. Would love to engage more there, but also please, my contact information is on JLL's website, both phone number and email, and I am responsive and would love to make some new relationships.
Excellent. And Jonah, I assume same, LinkedIn, email, phone, all available.
Smoke signals, whatever.
Throw X on there as well.
Right,
I'm a little less active than I used to, but I actually think that's how you and I originally connected a few years ago.
There you go. Well,
yep.
Any last words from either of you that you want to leave our listeners with that you'd like to just tell our audience? You know, these are mostly going to be operators, allocators, family offices, anything you want to leave them with. I'll give you guys each one last word or words. So Dale,
this is it right now. You know, I think this is what we've all been waiting for in the market turn. You know, you don't have to pick the bottom. Just, I think, start getting chips on the table. That to me is kind of the key moving forward from here.
To tag on to Dale's time, now is the time to focus on deals and capital raising. So plug for people like Dale and I. Let us focus on the debt. Go focus on what creates more value for your business.
Excellent. Well, Dale, Jonah, thank you so much for your time, for joining us on the Deal Flow podcast. I know that I got a lot out of it, and I'm sure our listeners did too. We'll make sure to put your contact information in the show notes and all the links to all those various social media platforms that everyone knows and I don't know if they trust them necessarily, but they know them and they like them. So thank you so much for your time, and we'll see you soon, maybe at NMHC next month. So yeah, thank you so much.
Thanks, Michael. Really
Thanks, Michael.
Thanks, Michael. Appreciate your time. This has been fantastic.
Thanks, Michael. Absolute pleasure.
Excellent. Thank you guys. Okay.